Hello, and welcome to our webinar, or Investing in a World of Changing Interest Rates, Tips for Investing, Tips for Asset Allocation. I'm your host, Kathy Siciliano, and family offices are constantly searching for the best ways to allocate their assets to maximize returns, and it can be really challenging to optimize asset mix in this environment of rising interest rates. So today we're going to have a really informed and hopefully lively discussion on the relationship between interest rates and asset allocation. We have two experts joining us today, Dan Siciliano and Sebastian Rivas. And I'll just do a quick intro before I turn it over to Dan and Sebastian. So Dan is CEO and co-founder of Nikkl, a fintech that invented a better way to invest in private unicorn companies. Dan is also a successful serial entrepreneur, corporate executive, venture capitalist, and an independent director on the board of the Federal Home Loan Bank of San Francisco. He's currently chair of the Council of Federal Home Loan Banks and former chair of the board of the Federal Home Loan Bank of San Francisco. Sebastian, welcome, is the founder and CEO of Andes STR. It's a PropTech company, a PropTech startup that leverages machine learning to help institutional investors invest in short-term rental real estate globally. Prior to leading Andes STR, Sebastian worked in AWS as a senior technical product manager within their data storage group, S3. He also worked in capital markets, specifically within real estate and infrastructure, and has been exposed to over $30 billion in transactions. Just a bit of housekeeping before I turn it over to both Dan and Sebastian. If you have a question, we very much welcome them. Please submit them in the Q&A box, and we'll be curating those and answering them throughout and at the end of the session. So with that, I'll turn it over to you, Dan, for the broad introduction.
Great, thanks, Kathy. We're gonna really try to keep this very informal and make it conversational. I've given too many lectures this week and it's only Wednesday, so I think what we wanna do is really just chat, Sebastian and I, but we're gonna try to follow a little bit of a format. And then as you mentioned, we'll try to switch to questions. So again, I encourage people to submit questions into the question queue, and we'll both try to, kind of incorporate them as we chat, but certainly get to them at the end. And if we don't get to them at all, and you've managed to submit a question, we'll try to reach out to you to kind of give an answer or point you in the right direction. So, this topic could be very, very broad or very, very narrow and specific. And I think, Sebastian, we're going to do a little bit of both. Obviously, we're in a world of changing interest rates, and I'm going to keep the screen up the way I was going to do full page, but I kind of want you and I to be able to see what's next in real time, and people are going to probably be trying to enlarge their screen to see what's next on the next slide. But what I want to do is just remind everyone of kind of the fundamental basics, right? So we have obviously experienced one of the most dramatic, on a relative basis, certainly, increases in interest rates in recent history. We went from a near zero bound interest rate as a practical matter to 500 plus basis points. It is a much more significant increase than if we'd gone, for example, from 5% interest to 10% interest. Going from nearly zero to almost 5% has tremendous and really kind of broad-based ramifications. And I suspect, looking at the list of who's on and whatnot, and kind of guessing as to levels of sophistication, any of us on this webinar could probably talk about the basic issues there, but let me just highlight them. And then, Sebastian, I'm going to have us tease out where it shows up in each of our different sectors. Your sector is going to be real estate writ large, and then I'm going to press you to kind of talk about short-term rentals because they have some idiosyncratic attribute type features in this context. And then I'm going to probably try to cover, and you should ask me some hard questions too, about growth stocks, particularly technology, and particularly private companies that would have been probably public in a previous generation, and what all this has to do with their valuation. So first, fundamental issue, discounted cash flows. We use discounted cash flows everywhere. It's it's the imperfect but universally used tool to figure out what the present value of something is if it has cash flows in the future. If interest rates go up, and if you want to be quick and simple about it, if the risk-free rate of return goes up, your baseline for what something is worth now, based on the same future cash flows, goes down. And if it goes from 0 to 5%, it goes down a lot. This is the source of lots of pain and angst in the economy right now. So if you look at the banking sector, when we have this hold to maturity versus available for sale, one of the factors that was the cause of the demise of Silicon Valley Bank, and arguably to a certain extent First Republic and Signature and others, was the fact that they had something that 2 years ago was worth a certain amount of money, and it had future cash flows, high quality treasury bills and the like, notes, because that's what mattered. They were longer term. And suddenly in a world with 5% interest as a baseline, risk-free, those became worth a lot less. So that's just the basic cash flow time value of money. We know that. And so the question is, what does an investor do? Now, on the one hand, you might think to yourself, well, this is actually a brave new world. It's a wonderful thing, depending on how old you are. It's been a very long time or never since you could go to the bank or you could go to a money market and park something short-term or relatively short-term, or if you want to go to your bank and lock in a 1 year or 2 year CD, if you're shopping around, you can get something that's 4%, 4.5%. And if you want to put it into short duration treasuries through a money market, you might be getting a notional 5 and something percent interest rate. It's been a long time since you could do that. So that's real cash flow from risk-free parked cash. But here's the challenge. The inflation rate means that the real rate, so there's the nominal rate of return. I just quoted a nominal rate, 5%, 4.5%, 5.5%. But the real rate of return, once you adjust for inflation, is probably negative, depending on a couple of factors about your real cost of living, what inflation version you experience, and what return you get, but probably it's still negative, which means if you had $1 million parked at 5%, a year from now, chances are that $1 million will not purchase the same $1 million it did today. And so you're actually losing money. So what are your choices? Well, it's pretty traditional. If you went to business school, if you went to undergraduate and took some econ courses, you get to climb up the curve, the interest rate curve, a couple of different ways. One, by either locking things in for a longer period of time, but that creates some duration risk. We'll come back to that. That risk is that if things become higher interest rate norms, then you're going to actually experience loss. The same way those banks did when they bought those treasury notes, 2 years ago, and suddenly interest rates went up. Well, that treasury note became worth less. Now, of course, if you plan to hold it to maturity, maybe that isn't such a big deal for you. But the other choice you have is to engage in investments that have more risk. And so one of the factors that we're going to talk about is how to assess what risk you're taking on and whether or not you're getting the right risk-adjusted return. In other words, what is that premium of return you get paid to take on more risk? And there's lots of different kinds of risk, and we'll kind of break that up a little bit into the different categories that we're going to discuss. So to summarize, first, it's a fundamentally different world. In fact, 2022, and if we have time, I'll pull up this document, 2022 as a year of 2 and 3 sigma magnitude moves of loss in fixed income, meaning what was the value of something that just provided a rate of return that was fixed, a bond or otherwise, was in most cases the largest year of loss on record for almost everything we kept records for. So corporate debt, short-term, government debt, long-term government debt, you name it. And so we are in a fundamentally different world. That's first. Secondly, even if you take advantage of those higher rates, you still probably have a real rate of return that's negative, which isn't great. Third, in order to get a real rate of return that's positive, you're going to either have to do something that has to do with a little risk or a lot of risk, and we're going to break that down for you. And then finally, how to think about that trade-off of risk. So that's what we've kind of set up. And I want to kind of highlight again on the slides a little bit. This first slide here, just, showing you the trend in US Treasury rates in 2022. So you've got the shorter end, which is the 3-month, that's the kind of darker blue, all the way to the 10-year and the 30-year. And if you notice over time, what has happened is the actual curve has either inverted or flattened, and we'll talk about what that means and what that has to do with anything. So I think I'll hold off on that slide, Sebastian, until you hop in so you can talk a little bit, but let's assume that's laid out enough of a groundwork or a foundation. And let's maybe talk a little bit about the one place where arguably you do have to take on more risk, but perhaps you can get an outsized return that potentially gives you a good, air quotes, we'll expand on that, risk-adjusted rate of return. And that's generally in markets that have either inefficiencies, asymmetries, perhaps pure arbitrage opportunities, though I'm always suspicious if someone says there's an arbitrage opportunity, look really, really hard, because smarter people with really big buckets of money often have, gotten rid of that arbitrage. And otherwise looking at those areas where you're taking on more risk, but perhaps you can do something more. So let's kick that off with perhaps, Sebastian, just a quick run through of the real estate investment world and what's happened to it and where there are pockets of better and worse return and what that means for you. And I might have you tease out some of the risks that are present now. And we will come, I already see some questions. We'll come to the commercial real estate market a little bit. I unfortunately have to spend a lot of my days because of the bank stuff thinking about that, but we won't neglect that. We'll come back to it. So Sebastian, go ahead.
Sounds good. Thank you, Dan. In the real estate world, interest rates are a pretty important thing because real estate investments, generally speaking, are highly leveraged, right? Among the very few asset classes where you can go 70, 80% leverage and as a normal thing day-to-day kind of stuff. So therefore, interest rates are pretty impactful. Now, interestingly, within real estate, you may think that, or many people think that high interest rate environments are bad, or low interest rate environments are bad. There's no real quick answer to that, but what everybody agrees on is that volatile interest rates are really bad, right? And the reason being, if there's no real good expectations or no consensus on what's going to happen with your cost of financing, basically your cost of funding going forward, it's very hard to understand what's the discount rate of the cash flows going forward, as Dan was mentioning before, right? So if a property is $1 million today, for instance, and it's generating $60,000 of a net operating income, is that high or low? Well, it depends. In an interest rate environment of 0%, it's probably pretty good because that means that you're getting a 6% spread over your cost of financing, right? So your equity is doing pretty well. But if the interest rates are 9%, well, it's probably not that good. So the problem today in real estate, generally speaking, is that nobody knows. There's no consensus on, is it going to go up? Is it going to go down? Nobody knows. So people, and basically when you do a transaction, you're banking not on today's rates necessarily, but the average rate over the next 5 years, because you can always refinance that, right? So your weighted average cost of capital over the time horizon is not necessarily going to be the same as the one you get today. And the entire market thinks that way. So therefore, there's no consensus for what's the right price. And that,
so Sebastian, let me stop and highlight something, because I think you're so immersed in it, you may not have realized this distinguishing point, and that is volatility is risk, right? So whether it's up or down, that's risky. The surprise up and the surprise down, is bad from a risk viewpoint. Now, mind you, if you simply sit long in a diversified market, surprise ups feel pretty good, all things equal, but it is still within the category of risk. So volatility, unexpected moves, or the inability to predict moves generally and having them happen is a type of risk. And I'm going to come back to this because both what you're doing in the short-term rental market and what Nikkl's doing in the private growth equity market have some features that are purposefully reducing volatility, right? And I want to keep highlighting that in a world of high interest rates and or moving interest rates, reducing volatility while still obtaining return, that's good risk-adjusted return. So we'll come back to that, but I really, you said that so nice. I want to really spell it out. So keep going, and I might, and tell me when to put up your slide if you want, but keep going.
Yeah, absolutely. So, well, actually, you kind of stole my words. That's exactly right. So the whole point today, where real estate is, that volatility is a risk. So therefore, it's very hard to price things because one side, it's very asymmetric in a sense. Once the sellers think, no worries, like the interest rates are going to go down, like everybody knows that, and therefore the prices should go up. And buyers are, no, like interest rates are going to stay up for a long time. So that causes a kind of a market making problem. There's fewer transactions being done, and therefore it's harder to place a market price on assets, right? That adds inefficiencies to the market. That makes markets less efficient because there's less information, generally speaking, that's flowing, or the information that's flowing, there's no consensus. It's not perfect information, and you need free flow of perfect information for an efficient market, right? So that makes it very, very hard to invest in that environment, generally speaking. And that's, generally speaking, also a source of added cost to the economy because there are deals that should be done, but they're not being done, right, etc. So that's at a high level before explaining more about short-term rentals and going into exactly what Andy's does, the current theme in real estate, right? So maybe that's a good point to kind of switch back to Nikkl.
Yeah, and let me tease that out, and I'm gonna, a little bit of a spoiler, but I won't steal the whole thing. So if you can discern value through some mechanism better than the market can generally. That gives you a big advantage in that story, right? Because some of the volatility and risk was because you can't arrive on appropriate value. That's common in inefficient markets. And secondly, if after identifying insights about value that are a little bit better, or a lot better than the marketplace as a whole, if you can engineer, some reduction in volatility through whatever mechanism, then that's an extra bonus. So value identification and engineering reduced volatility, if you can keep the same rate of return, that's like a big home run in the world of kind of, both theoretical and applied finance. So keep going, and let's kind of build on that, because it's so interesting to me that the parallels in the kind of smart short-term rental market and then the kind of smart access to like unicorn companies market, they are so parallel in that regard. So you keep going, and I think Kathy's ready to pull up the screen when you need it.
Yes, so it might be actually a good time to pull up the screen. So real quick, I'll also mention what we do at Andy. So basically what we do is that we help, we basically identify properties, whether it's whatever the asset class, whether it's multifamily, single family, whatever it is, that would be highly profitable as short-term rentals, and short-term rentals being basically these properties that you would list on Airbnb, VRBO, Expedia, all these different platforms. Now, an interesting thing is these properties are the exact same as any other property. You're just changing how you derive revenue, right? Now, I'll go back to that in a second. Now, let's assume for a second now that long-term rentals, so just regular real estate rental,
So that's the top left here, LTRs, long-term rentals. Okay,
exactly right. Let's assume that that is an efficient market, right? Which it largely is, because nobody wants to leave money on the table. Nobody wants to overpay or underpay for a deal, and there's a lot of information about the cash flow component.
And there's some really big institutional players in that, right? Who've been there for a very long time, and they're vertically integrated. So that's a really well-run market, all else equal. So you would expect
exactly. Exactly. So as you mentioned before, any arbitrage opportunities are competed away, right?
Yeah, Blackstone pounded them out of the market. You're not going to get
absolutely
them.
Exactly right. So from a mathematical perspective, the way that looks is on the top left chart there. If you're to chart out their expected returns, and we can call them cap rate, which is like yield on cost, basically, right? A yield metric. They would distribute very narrowly. In other words, if it's a market where you're getting 4% returns, you're not going to find an asset that's 9%. There's something odd there.
Something's gone wrong, or it's fraud, right? Like maybe one property in a blue moon, but you're just never going to find anything at any real scale ever.
Exactly right. Now, what would happen if I told you that there's, for a similar asset, let's call it a different asset, same house but just next door, and you can't really predict the rent now. Like nobody knows the rent, because on long-term rentals, you just call CDRE, JLL, and somebody will tell you the rents. Like everybody knows there's a metric, there's a rent per square foot or something like that. So you can estimate cash flows pretty accurately because it's efficient, precisely, right? But
we
then
call it price takers. So if you own a house and you're putting in the long-term rental market, as a practical matter, you're a price taker. You don't get to say, today I will charge 10% more, and people will line up. That just won't happen. Okay.
Exactly right. Now, if I told you the house next door, it's extremely hard to know how much rent you're going to get. Well, that makes it inefficient because the information is not perfect, it's not free flowing. So when that happens, the end result of those purchases looks like the chart at the bottom left, right? It's a wide distribution. If you're not sure, like if you invest $1 million here, you're not sure you're going to get $40,000 in profit or $100,000 in profit. You're just not sure. And therefore, that's what happens. Like the distribution, the probability of getting a certain return, it's kind of all around the place. Now, very interestingly, one thing that I said before, this happens with short-term rentals, because if I ask you how much money can you get on this property throughout the year if you list it on Airbnb, kind of very hard to tell. It's pretty hard. That's kind of the reason that market is inefficient. So another thing I said before was short-term rentals are kind of a free option. It's just a way of deriving revenue. It's not an entirely new asset. So you can switch back and forth. You basically have the option to rent it out on Airbnb or the option to rent it out as a long-term rental. So when you combine those two curves, the one on the top left and the one on the bottom left, you get basically the curve on the middle right.
So
right?
let me restate that. And at Stanford, when I taught finance, we're kind of kinder, gentler than Chicago. So we use flower shops, right? So you have two flower shops in the same town. They're not far from each other. They have same square footage. One can produce per square foot sales and net profits well above another. And it has to do with all sorts of things, how friendly they are, how bright it is, whether or not they've tightened their relationship with their supplier and all that kind of thing. If you go to grocery stores, with some rare exceptions, by the way, because there are a couple standout exceptions, but generally speaking, grocery stores, plus or minus 0.5%, on net margin. I mean, you just can't compete. And so what you're sort of describing is that there's a wider band of possible outcomes for the short-term rentals for all sorts of reasons, which maybe you'll mention one or two, but that means that the savvy player, someone who can get insight and do things differently, like the smart flower shop person, can extract a lot more value from what otherwise is a commodity in the long-term rental market, right? And the short-term rental market, it's actually much more idiosyncratic. Now, I know at Chicago, you probably use cement factories or something dark and gray, for that same analysis, but we'll keep in mind the flower shops, or in this case, the short-term rental market. So what does Andy's STR, how do they gain that? How do they make sure they're on the right side of this distribution? Like what's different? Because if it was random, you could actually end up on the left side of that distribution. That'd be really bad. Right. So I assume it's not random. In fact, I know it's not, but how is it not random?
Well, there's two things here. First, there's a structural component. Even if it was random, you would still end up with the right side of the curve, or not the right side of the curve, but with the right chart, right? If it was random, you would not know whether you're the right or the left. But the thing is, if you end up at the very left side of the short-term rental curve, on the bottom right, or the bottom left, sorry, you would not do short-term rentals. You would opt to get a tenant, right? So you end up with the left side of the efficient curve, of the top left curve, right? And that's still pretty good. And if you luck out and you get, the really good property that generates a lot of cash flow, then you end up on the right side of the curve. Right.
And here's an example. So I want to emphasize this free optionality, right? It's not quite free, but this optionality creates tremendous value. So let's imagine an entire state. I don't think this would happen, but an entire state. Florida's been doing some weird stuff. This won't ever happen. But what if they banned all short-term rentals, right? If they banned all long-term rentals, everyone would blow up and be terrible. But if they banned short-term rentals, you could flip. So suddenly you all of a sudden ended up on the left side of that curve, right? Very bad news if you happen to be there. But you could flip into the long-term rental market and you'd be back in the very tight band, right? So having the option to respond to sudden shocks to the market where something happens that you just never expected to happen, that is extremely valuable. And it's not common in finance. You normally have to buy that coverage. Like you have to buy insurance for the surprise events. And if no one thinks they'll happen, the insurance can be pretty cheap, right? But if people worry that it might happen, the insurance can be very expensive. In your case, it's a built-in feature of using a property for a short-term rental. You always have the option, because it's a short-term rental, and 3 days later you can say, you know what, we're going to rent it for a year to a tenant.
Exactly right. And the way to see it is what Dan just said is, if Florida decides to ban short-term rentals,
which they won't, just to be clear, they're not going to do that, but I'm just using that crazy example. Yeah,
exactly. You would end up here in the curve. But what also Dan said is, well, you stop doing short-term rentals at that point and you just land here with a tenant. Right. So this part of the curve it doesn't happen really. Right. It's fictitious.
You can always opt out of it.
Exactly. You would never choose. Right. And the result is this curve right here, basically. That's how it looks like in real life, right? Well, and by the way, that would be the case if it was purely random. What we are doing at Andy's STR is we are not making it random. We're making it a little bit more deterministic. So I'll give you an example. Actually, for example, the way to determine this is by making an inefficient market efficient. Basically. And that means basically gathering the data that may be hard to gather, that others are maybe not gathering, but gathering that data and giving it purpose. So I'll give you an example. If you were to, if you try to forecast or estimate the cap rate or yield, return profile, IRR, whatever you want to use as a metric for a random property within Orlando, you could use certain variables like that you could use anywhere else. Like for instance, number of bedrooms, number of bathrooms, right? Like square footage, all else equal, probably more bedrooms makes you more money than fewer bedrooms, right? And that's probably right, but with a big variability because like people are willing to pay for other things. If you have a nicer TV, probably you're willing to pay more for a stay there than if you have no TV, for instance, right? So it's more variable, right? But not necessarily random. So what we do at Andes is that we create in-depth, very, very powerful and market-specific machine learning models that use over, in Orlando's case, for instance, over 400 different variables, all with some predictive power and specific to that market to really estimate why is it that some properties make more money than others. Concrete example. There's one variable that works in one pocket of specifically one pocket within Orlando, not everywhere, but for that pocket, it's the travel time by car at peak traffic hour between this property and Disney World. And that kind of makes sense because
as soon as you say that out loud, it's completely obvious, but,
yes,
it maybe would not have been obvious. And by the way, I can vouch for you that machine learning and AI was built into the DNA of the company from the very beginning when you guys won the Chicago Graduate School Business, the Booth School Startup of the Year award thing. You were already talking about AI. It's not an add-on as of ChatGPT, so it's legit.
yes.
and genuine machine learning that, as I understand it, you've been tuning for a few years now. So yeah. those multiple variables have actually really advanced quite a bit and have quite a bit of weighted precision.
Oh yeah, exactly. And when we back test and our track record speaks for itself, absolutely. Our absolute margin of error is like 6%, which is incredible. Yeah, it's really, really good. So yeah, well, anyway, so basically what that's telling you is for some properties, it's clear that people prefer to stay in traffic 10 minutes to get to Disney instead of an hour, right? Yeah. And therefore you're willing to pay more for a stay in that property. Yeah. But now let's think about, how do you know the value of that property? How does the market dictate the price? Since nobody or very, very, very few people are using this information that I just said, because it's highly local, it's specific to not like a quarter of a zip code, right? So nobody's really using that information to price the assets that we're talking about. Everybody's using the long-term rental rates to price the assets. But the thing is that the long-term rental rates, in other words, that the monthly rent that you can get with a tenant, is not correlated really with the short-term rental rent. In other words, if you ask a tenant, would you be willing to pay more in your monthly rent if you're 10 minutes closer to Disney? They probably don't care. They probably care about good school districts. They probably care about Whole Foods, right? Other things. So therefore, we can find for one price, one asset that's correctly priced using the long-term rental cash flows. In other words, an asset that's correctly priced at this cash flow level. If we can find that, if we figure out that that asset actually creates this level of cash flow, then we generated that alpha, then we generated excess return, even in an environment of volatile and high interest rates, right? And that is what we argue it's the smart thing to do, especially in these times.
And so let's summarize a couple of things there and kind of keep moving forward, because I like how you've set it up. Now, so first, in no particular order, if you can find an asset that has very low or no cost to be repurposed for different use that also is highly valuable, you should select that asset, meaning if it can pivot into something else. And there are very few assets that actually meet that definition, all things equal. And you've identified in real estate, that's sort of true, but it's very costly, say, to convert, discussions underway, office space in Manhattan into residential space, but that is an expensive proposition. In your case, you can flip an LTR into an STR, or more importantly for you, an STR into an LTR with very, very little cost. And that's so look for repurposing optionality, which is highly valuable to an asset on a probabilistic basis. Okay, that's the first. Second, look for specific characteristics that can be observed and can alter the value, which are non-obvious. And we in financial services, and anyone who's spent any time in almost any professional industry, industries that are highly specialized and require a lot of time to really get good at, they have a lot of momentum. And we kind of joke in finance that, if there isn't already a tab for it on the spreadsheet, then people are very loath to change their models, which explains why the pricing structure writ large for short-term rentals is being run on a model basis by some of the big players as the long-term, pricing structure. It's just, it's going to take a few years for them to kind of figure it out and sort it out. And it's not that anyone's lazy. It's just that there's not a lot of upside for creating a new tab in the spreadsheet that might be wrong, right? You don't get rewarded correctly unless you're a startup, right? Unless you have the freedom to kind of build from scratch. So that's the other thing, a specific characters. Then finally, this pricing value. If you can find a way in which you can alter the price of the asset, that's win-win. And we know the phenomena in behavioral economics and psychology. People on vacation people engage in short-term leisure activities, even if they are not particularly wealthy, they have a particular mindset about spending. And it's actually quite rational, right? It is, they suspend their normal rational behavior around money for a period of time. And that's why, by the way, if you ever go to like a timeshare, that's why they're pitching you at the timeshare, because your mind hasn't switched to its rational basis and will not scream at you, don't buy the timeshare just because you're having a good time, right? But in this case, you've taken advantage of what is a perfectly win-win rational behavior around spending extra money for lots of features that you wouldn't spend for over the long term in your regular life. I'm going to come back to Nikkl on that, because in our world, it's about what is the price per share that you're going to pay if you manage to get access to these hard to get access unicorns, and who are you going to buy that from? And are they going to be happy about a particularly low price per share? And it turns out the answer is yes, if you do it just right. So, okay, with those things in mind, let me just flip over to Nikkl, and there's going to be a lot of parallels. So, what Nikkl does is, from an asset, allocation viewpoint, we take a different spin on what you might think of as growth technology companies. So if you've been investing in the stock market for 15, 20, or 30 years, you know that, there's a lot of opportunity and growth in technology companies. But 20 or 30 or 40 years ago, you had a chance to invest in Apple or Intel, then Apple, and then Cisco, and then Google, and then NVIDIA. And you had a chance to invest in all these wonderful companies when they became public, right? Which was, relatively speaking, nowadays, pretty early in their life cycle. Most of them weren't worth $1 billion at the time. They still had 99% of their growth ahead of them. Fast forward to today, and the reality is that most of the great companies that are disrupting markets and have tremendous growth opportunities, the unicorns worth more than $1 billion at any given time, are privately funded for a lot longer, such that that growth occurs before they go public. And then once they're public, they can be great companies, but they're not going to be the 1000x that NVIDIA was. They're not going to be the 500x in the first 10 years of Atari or Intel or Apple. Like that's just not going to happen, because they showed up as a $50 billion company. Yay, if they go to a 250 billion, what a great, like 5x in 10 years, you're doing great, but it's not the same opportunity. So what do you do about that? Well, what you want to do is, if you can't be Sequoia, there's only about 10 or 12 global investors who get to invest in lots of unicorns. You got to figure a way onto the cap table, or a derivative that isn't quite the cap table. And that's what Nikkl does, because we have relationships, and I mean hundreds and thousands of relationships with unicorn employees. And we created this product that conforms with all the regulations and the like. It's been an evolution across many years. It was a Stanford project that spun out. We can advance employees the cash that they need to take their vested options and turn them into shares. Why would they want to do that? Because you save a lot of taxes if you do it correctly. You turn what would be ordinary income into long-term capital gains. It's also a little safer, because if you lose your job or you have to leave because you have to go take care of an elderly parent and you're doing great, that option agreement, it expires in most cases if you leave, or if it hits 10 years. But if it's shares, that doesn't change. So we can give employees that capital, they exercise it, they get the shares, they pay for their taxes, a portion of the taxes at that time, and then we have the opportunity to benefit with them when it becomes liquid. They pay us back the capital that we advanced. So in this case, we decided their shares were worth 2.5 million. We gave them $1 million. Fast forward a couple of years, and they have an IPO and it exits, and that 2.5 million is now worth about 3 times that. Which, by the way, taking out the high-end outliers, that's kind of been the average over the last 10 or 11 years. We get our $1 million back first, and then we get a piece of it. Yeah, it's about 10 or 12%, depending of the total return, which gives us a really wonderful IRR. So you talk about cap rates, we talk about IRRs. And importantly, it's less volatile, because you can kind of think of it like a loan. It isn't really a loan, but that first $1 million gets paid back first. So if we're all terribly wrong, despite getting a great price and doing it all right, maybe the economy just tanks. The war in Ukraine gets much worse, terrible things happen. And that, instead of going from 2.5 million of value, drops to 1.5 million of value, or 1.25, it goes down by half, which would be really terrible. Well, in this scenario, we get the $1 million back first from all the available value. And so even in a scenario where the price went down by half after the IPO, we would still get a positive IRR, which is really saying something, which is a wonderful alternative compared to, say, buying it on the secondary market if you could. So again, to recap, it's an inefficient market because people aren't really good at accessing and doing it compliant and getting to the right people, the employees. It's a less volatile asset because it's designed so that it has this downside protection. And frankly, in the long run, that's the place where you get outsized returns. It shouldn't be your whole portfolio, but in a blended portfolio, you should have real estate, you should have technology, you should have utility, you should have, a diversified portfolio. And unfortunately, mere mortals, those of us who aren't, multi-billionaires or one of the 10 or 12 investors who get to do unicorn investing, there's no other easy way to get into unicorns. And as a philosophy, Nikkl thinks that that's a bad thing. Like we're happy to help the unicorn employees, that's great, but we're really happy to help everyday investors and family offices and others get into these unicorns early stage.
Hey, Dan, so quick question. So then kind of what you're saying is that you, just like in Andy's, basically, you found out a very, very smart way of getting that asymmetric risk return profile, because you have kind of almost like a liquidity preference, right? Like you have like a first divs that limits your downside. And if they do well, you get that extra upside, which is kind of in the short-term rental world. Yeah, that property crushed it, right? So you're making more money. And it makes sense. It's kind of predictable because you're adding value to the person who's actually selling or giving you access.
Exactly. Yeah, the tax arbitrage motivates it, right? So the reason this is an interesting marketplace is because we are the first product. Yeah, we spent 2 years and a lot of money working with DLA Piper and Deloitte and others to create a conforming product. It's a prepaid variable forward contract, and it has a IRS and a Treasury reg that you have to follow. And in so doing, it's conforming and you get this tremendous tax advantage, and it's rock solid. It's been sorted out over the last 20 years. And so if that happens, then that means that unicorn employee has a reason to do something even before they leave, even before they worry about their options. They just want to save money, and you're divvying up that arbitrage. It's a real tax arbitrage. You're divvying up that arbitrage and also benefiting from the very solid historical pattern that once a technology company is a certain size and have product market fit and they can get more capital, there's growth. And now, mind you, there's always risk to unicorns, but their rate of failure is a fraction of earlier stage companies. And if you can invest at the right value, then you can do very, very well in a diversified portfolio. And by the way, you're exactly right. That downside protection is mimicking a little bit of what it looks like to be a VC, right? Like it is similar. You get a liquidity preference if you're in a preferred share round. And there's a lot of elements that go into that. But let's just say we've spoken to thousands of unicorn employees. We've deployed capital, and there's a bit of an art and a science to it, which I think means it's a craft, right? Like you master a craft, and it really is a win-win, and provides these great IRRs. Now, will that arbitrage last forever? I don't think so, but will it be in place for several years? Yes, it's just because of the nature of the market. It's rather opaque, but it is huge, right? So it's a multi-billion-dollar market. So yeah, let me pause there. We have a couple questions, I think, and maybe Kathy, did you want to post those to us, or did you want to just pose them outright?
Yeah, I'll just read them off. We have two
Great.
that came into the chat, and I invite everyone to submit questions via the Q&A. I'd be happy to answer them. The first question is, and I'll just read it verbatim. It's, in such a complicated investing environment, isn't there a certain practical safety in holding cash, especially since there is a decent risk-free rate of return? A decent risk-free rate of return.
It's a great question. So, I just read yesterday that JP Morgan customers are allocated to cash at the highest rate in the last 20 plus years, right? So people are in cash, and there's nothing wrong with that per se. If you're in cash and not equities, and equities suffer a tremendous loss, then you have, relatively speaking, done quite well. But here's the fundamental challenge with cash, and that is current investments in cash, even tax efficient and in the highest possible yielding categories, are below the rate of inflation. And so cash has a real rate of return, which is negative. That doesn't mean you shouldn't be at least partially allocated to cash, but what you're really trying to do is you're trying to de-risk portions of your investment. So the broader way to think about it from an asset allocation viewpoint is to say, okay, I was 10% in cash, and all of a sudden I'm in 35% in cash. That's a lot of cash, by the way, especially if you're under 70. So like 35% in cash. What does that cost me? Well, it could be costing you a negative 2 or 3 or 4% per year, depending on the circumstances. And that's very expensive because realize you're going to still pay taxes on the nominal rates of return. So it's kind of a double whammy. So what are you trying to do? Well, you're trying to reduce downside risk, probably. You're trying to reduce volatility. You're trying to do a lot of things. And so there are other choices, and that's where the asset allocation comes in. If you can find pivotable assets, assets that have two uses. If you can find an asset where the pricing is ambiguous, but there's an advantage in that you get the best pricing. If you can find an asset that the value, so pricing meaning your acquisition cost is ambiguous, and then what you can get from that asset, meaning the income. So in Andy's SDR, or that would be like the cash flow from the short term, where that's, there's an advantage or something you can do there in an inefficient market. Those things reduce the risk relative to, for example, price takers in the public equities market. Like you're a price taker in the public equities market. You don't get a special price for Intel if you work really, really hard to find a special share of Intel. It just doesn't work that way. But you do, if you do it correctly in inefficient markets, find a unique opportunity to invest in Chime at a rate that's lower than you thought, and works out and has downside protection, or a property in Orlando that will yield more because it has certain features. That's if you're heavily allocated in cash, contemplate a part of that. Personally, by the way, when I was tempted to really reallocate out of big tech, I did some of that, but I actually diverted it into like Nikkl tech allocation, because again, it had less volatility. It has the downside protection as opposed to simply going to cash. Sebastian, I didn't mean to answer that whole question, but you again, as a Chicago guy. In fact, your first slide, I loved the bottom there. Your Chicago props would be very proud. Yeah, maybe give us your take on cash in this environment.
Yeah, no, I fully agree. My only addition would be, I think people see cash today as an option, right? As a kind of a put option. So if things get better, I want to be allocated or unallocated. I want to have that freedom to make the most of that future opportunity. But what I think, so that has some value. But I think the problem is that people very often forget that it's not possible to time the market. So in reality, it's a kind of a negative value option, precisely because of the erosion from inflation, right? So I fully agree. I think it's fine having some percentage in cash, but I'm not entirely sure it should change all that much throughout the time. Right, like I don't think, because I agree. What we're seeing is that now cash allocations are increasing significantly, and that probably doesn't make that much sense, especially when you can get alpha basically from with companies like Nikkl or Andes.
So we've got one more question, and then we can wrap up after that. I know folks typically or they're scheduled by the hour, and so we want to give you time to get to your next. This question has to do with timeframes. So typically with venture investing, including unicorns, it requires a very long time frame for liquidity. So Sebastian and Dan, can you both talk about, from your product perspective and your own perspective, how folks should think about timeframes when it comes to different asset allocations, specifically with Andes and Nikkl?
And this is where Andes and Nikkl actually differ quite a bit for a variety of reasons. Sebastian, you should answer that first, and then I'll kind of follow with the answer about the time frame for the Nikkl product.
Yeah, no, in real estate, it's generally speaking, it's an illiquid asset, right? Like in real estate, you should kind of buy thinking about holding, and mostly because there are transaction costs, right? There's a brokerage cost, etc. Now, a real good advantage of working with Andes is that our transaction costs are significantly lower, right? Because it's a long explanation, but long story short, it's like a fifth of the transaction cost, so you can actually trade a little bit faster. But in general, finding these assets is not that easy either, right? By definition, if you are if you're trying to find the right side of the tail, well, it doesn't happen every hour, right? So generally speaking, it makes more, if you need liquidity, it makes more sense to refinance the asset and take some equity out using debt and lower cost of capital, basically, rather than buying or selling. And that's how you get the liquidity in these assets. But I wouldn't consider any kind of real estate investment as a short-term or anything even close to cash or equivalent. Like it's just an illiquid asset. And the average investor hold is 5 years, right? So I think that's the right mentality to go into a short-term rental investment.
And Sebastian, in your case, it's possible that your cash flows, because you're optimizing cash flows, could be such that, that it's okay to hold for a very, very long time.
Yeah.
If you have an asset that you need to hold because there are transactions costs and hopefully it appreciates, but you're getting cash flows in the interim, well, then that's a nice offsetting consideration. Nikkl, on the other hand, again, for example, we have a current SPV, special purpose vehicle, that's spinning up, and it is a very opportunistic targeting of 6 companies that are all unicorns. They, out of 1,500 companies, by the way, we do a sorting and selection that reduces it to really about 80 or 85 eligible companies. And out of those, there's about 25 at any given moment. These 5 or 6 companies have very low valuations relative to their opportunities and are also likely very close to a liquidity event, probably an IPO, meaning they're ready to go as soon as the IPO market reopens or the IPO window opens a bit more or thaws. They're likely the first out of the gate, which means therefore that the time frame is maybe 12 months, 18 months, 24 months, 30 months, depending. And so that SPV gets pulled together. We end up funding these employees. They end up having the shares, which we then hold in a complicated, legally secure way. And then within a year or two, you have liquidity events. During that time, though, you don't have any cash flows. But the offset to this is that you actually have very high capital returns. And so it's not locked up for 5 years or 10 years. It's actually much shorter. And in reality, that opportunity is, really kind of quite rare to be able to have in the venture space, something where you make an investment and you have a line of sight exit in like the 2 to 3 year timeframe. It's because we're picking at that stage of the unicorn cycle. And again, you can't normally get access to that, but we can get access to that through the employee. So it's a very different thing. Well, we've actually managed to use up all our time. Sebastian, I had fun. I think you had fun. Yes. I hope that those who had a chance to listen and participate found it informative. And thank you for the questions. And there's a couple others that we'll certainly respond to directly. And we appreciate it. And kind of to wrap up, we're in an unusual rate environment. It means that you have to be more thoughtful about how you get better returns. Cash is sometimes wise, sometimes not. It's complicated. Pay attention to real rates of return, not just nominal rates of return. And then once you have that in hand, go looking for inefficient opportunities where there's either a dual purpose use for the asset and it can pivot, or you get a special feature that's non-obvious, or you can get pricing that's unique, and that you actually have the ability to manage the quality of the deployment of the asset, which is both the case with Andy's STR and Nikkl. And if you can do those things, you're going to have a much better time reallocating your assets in such a kind of tricky interest rate environment. And we'll certainly have follow-ups. Please join us in the future. We'll be doing a few more of these webinars with select different topics each time, and hopefully you'll have a chance to join as well. But thanks, Sebastian. It was really great to have you. And thanks, Kathy, for hosting, and thanks everyone for joining us.